Well, after HDFC Standard Life, market regulator SEBI may now issue show-cause notices to other insurance companies on products that do not have an insurance cover.
All right. Sources say SEBI is seeking information whether this amounts to selling mutual fund-like products under the garb of insurance. In response to CNBC TV18's query, HDFC Standard Life declined to comment, but insurance regulator IRDA came out in defense saying that no regulations are being violated by HDFC Standard Life. Right. Joining us exclusively on the phone line is IRDA member Dr. R. Kannan. Mr. Kannan, thanks very much, sir, for joining us today. You've been seeing over the last 24 hours the manner in which this entire controversy is unfolding. The market regulator feels that there are certain insurance products in the market which are ULIPs, which do not have an insurance cover, and it wants to know whether these products are nothing but mutual funds.
Yeah, that's a good question. If you look at Section 211 of the Insurance Act, the Act clearly says what are all the products which are covered by the insurance. If you look at especially Section B and C, they clearly define the annuity products. When you talk about annuity products, you can have one on a traditional platform, the other one on the unit-linked platform. On both the things, whether with the life cover or without life cover, because you are having a longevity risk which is borne by the insurance company, it is classified as insurance product. And these products are cleared by IRDA, and we do not see any violation of the regulations.
Right. Dr. Kannan, you've given the legal perspective. What you're really saying is that an act passed by Parliament allows you to issue an annuity product which can be a ULIP as well, can be a unit-linked plan as well. Now, my question to you, sir, is that let's go to a more larger issue. You have been well aware that there is an issue which has been concerning investors, industries, both the industries, of regulatory arbitrage that exists. I mean, you have almost two similar products functioning under two different regulatory jurisdictions and terms. Whether it is the commissions, whether it is the way they do business, one can understand where there is an insurance cover involved. But it's very difficult to explain that, you have a pension plan even under a mutual fund, you have a pension plan under an insurance company, both are almost similar, and yet totally different set of treatment for both of them.
Here I beg to differ, because if you take an insurance product, especially the annuity product, this annuity product is really having a longevity risk. For example, you buy an annuity for 100 rupees per annum for 1,000 rupees, for example. Roughly, this will go up to 10 years. Suppose if a person survives for 20 years or 25 years or 50 years, the company has to pay 100 rupees per annum as per the original contract. Whereas in the case of the mutual fund, it is a drawdown balance. Like I have 100,000 rupees, 100 rupees I draw, the balance 900 rupees. Till the balance is in the account, one will draw the pension or whatever. It is a regular withdrawal. A mutual fund cannot issue a pension product. Here it comes the two.
Mutual funds do issue a pension product, Dr. Kannan. We have UTI's pension product which has been around for years.
But that is the longevity risk is not, they cannot hedge the longevity risk.
But in the case of these products which are under the scanner, where is the longevity risk being protected? Because there is no guarantee, there is no cover at all. There is no insurance cover at all.
Let us put it like that. There is a two phase. One is the accumulation phase. The second one is the benefit payment phase. In the accumulation phase, according to the unit performance, on the day of maturity, the total number of units multiplied by NAV is the total maturity proceeds. That proceeds is used to buy an annuity. So, nobody can take the cash and walk away. No, the policyholder is not eligible to receive any cash payment except the commutation amount. He has to buy an annuity either from the same company or from the company of his choice. For example, if I buy an annuity from HDFC Standard Life, if I'm not happy, I can buy somebody else, some other insurance company. Then HDFC Standard Life will make the payment to that company, and that company issues the annuity to the policyholder. So there is no question of no cash. It is a pure annuity. And as I told you, if a longevity risk is there, this longevity risk can be borne only by the insurer. It cannot be borne by a non-insurance company.
But where is the insurer in this case bearing that risk? Because there is no life cover. There is no insurance cover at all.
There are two. The life cover is not there during the accumulation phase, but on the benefit payment phase, he bears the longevity risk. If there is a life cover, then the sum assured payable at death is sum assured plus the fund value. So, if a person buys a pension with the life cover, then he will have a life cover risk during the accumulation phase, but on the benefit payment phase, the longevity risk is borne by the insurer. This distinction is a very important thing, and that has gone well in Section 211 of the Act.
Dr. Kannan, a broader question of how two regulators have taken a different view on a product. Do you agree that there is a grey area on who's regulating and what kind of regulations apply to this product? And for a customer who is completely confused...
I'm very clear that whatever the products which IRDA approves, as a member actuary which I approve, it is well within the regulations, and there is... It's a regulatory arbitrage. Is it an investment product or it is an insurance product, etc.? Now, I have my own doubt. It is a clear and insurance product. There is no doubt in that.
All right.
The only thing is, between a traditional product and a unit-linked product, in a traditional product, the sum assured is a guarantee. Suppose you buy a pension for 1 lakh or 2 lakhs or 3 lakhs, the sum assured is a guaranteed amount. Whereas here, it depends upon the market performance. So, at the time of maturity, the number of units multiplied by the NAV, you get that money. To that extent, the investment risk is borne by the policyholder.
Right. Dr. Kannan, you spoke about the longevity bit. Now, my point is, even if I have invested in a mutual fund, after 20 years, after my accumulation phase is over, I can also go and buy an annuity from any insurance company. And what you're really saying is that even when I buy that annuity, I will get that commitment from the concerned insurance company. So as far as the accumulation phase is concerned, don't you think the two are just mirroring each other?
When you buy a pension product from an insurance company, a person gets Section 80 CCC benefit.
So does UTI's pension plan. Dr. Kannan, so does UTI's pension plan.
Yeah. That issue one has to really examine.
No, so that's exactly my point, sir. That's exactly the point, that you have actually two sets of products which are similar under two different regulatory jurisdictions.
Now, which we are currently examining,
right,
is on how the UTI is in a position to sell the pension, how they are this one. That is the issue. Probably, so I'm very confident both the regulators will sit together.
Is the next step going to be you issuing a show cause to UTI?
No, not at all. We are having an excellent relationship with the SEBI, and we will take it up with the SEBI internally and then settle out beautifully well.
All right. SEBI has written to you as well, Dr. Kannan, to IRDA as well.
Yeah, to the best of my knowledge, I have not received any communication from SEBI to this extent.
No, I'm talking about the HDFC Standard Life notice.
Yeah.
You have not seen it, but I understand IRDA has received it.
I doubt very much.
All right. So what you are going to reply to the regulator is that this is well within the law. But what you are really saying is that the larger issue is something that you would like to look at with the SEBI. Is that what you're really saying?
That larger issue which we would like to say, but I categorically say all the products which we approve are well within the ambit of the Section 211 of the Insurance Act.
But there are larger regulatory arbitrage issues. You're acknowledging that.
The regulatory arbitrage issue is in the peripheral stage, but if you look at in the core arbitrage issue is not there. Because the way in which we perceive the unit-linked product and the traditional product, the distinction has to be understood very carefully. That is my submission to all of you.
All right. Thank you very much, Dr. Kannan, for making time and talking to all our viewers. Thanks very much. We appreciate that. Well, coming up...